Everybody, welcome to today's video. We're going to be talking about how you're going to be losing 40% of your RRSP. Now, I'm not just going to be saying why you're going to be losing 40% of your RRSP. I'm going to actually show you exactly what you can do about it. And so it's not all bad news. And if you're new to this channel, please feel welcome to head on over to my YouTube channel where there's all kinds of videos on everything to do with retirement planning, estate planning, how to manage your money, how to invest your money in life insurance, or how to use life insurance. If you're a business owner, an individual, or family, I think you're going to get a lot out of the videos that I've got on my YouTube channel. So let's get to it. Okay, so what I'm going to be sharing with you today is something I think that is most likely the most overlooked planning issue, which is about anybody that's planning in their retirement. And I say that because I've had over 20 years of helping people plan for retirement. And when I talk to people that come to me for the first time, I see this just about all the time. This is one area that is most overlooked. And the thing is as you're more successful in saving money towards your retirement, this issue just gets bigger and bigger. This mistake that you're making just continues to grow until it's awfully painful and very difficult to fix. So let's get into what it is that biggest problem is, and it's taxation. Now you're probably thinking, wait a minute, that's not my biggest problem. Well, I'm not talking about the tax you pay on your salary right now. I mean, after all, that's why you are investing in an RSP to begin with, because you're trying to lower the income tax you're paying. If you look here in the chart, you'll notice this is the Ontario marginal income tax table. On the left-hand side is the green area. That's your income going from the least amount, and as you go down the page, the income's going up. So don't get confused by that. But essentially, as you make more money, you pay more income tax. That red area is the income tax you pay on the graduated amount that you make. So as you make more money, you pay more in tax. The other tax tables on the right are really about different kinds of income tax, but we're going to be talking about exactly what this means to you when you pay income tax. So as you're making more money, you're trying to save money. And so that's that reason why you deposit money to an RSP, to make your tax rate go down. So you can see that arrow was saying, let's say you're starting at 53% taxation, and when you make an RSP contribution, that lowers your income tax. So that's one of the reasons why you invest in an RSP. Now, the other reason, of course, is you're trying to put money towards your retirement. And this is a sound thing to do. It's what everybody tells you to do. It's what you ought to be doing, because the last thing you want to do is be in retirement with no money to retire. So it's what you're doing is right. But the problem is we're only mostly focusing on that area, mitigating taxes year over year. And so what we're really talking about is, let's just quickly review, and this is going to share with you. And when you see this, I want you to think about your own planning and see if this is true in your situation. If it is, put it in your comments below, because I want to hear if this is true of you as well, because I love hearing your comments, by the way. So phases of retirement. Let's look at this together. This is the accumulation phase. 18 to 59, you're working, you're saving money, you're paying down debts. That's the sort of competing agenda. The retirement zone, have a look at this video up here. I'll talk about what the retirement zone is. And then you're in active retirement, you're using your assets, and then you get to the final spot, which is legacy. This is the biggest problem. This is the biggest mistake right here. Everybody focuses on those three boxes, but very few people focus on the very end, because I know a lot of people say, well, I'm dead anyway, what do I care? Well, let me ask you this. Are you the kind of person that wants to pay the least amount of tax year over year to Revenue Canada? And so you do all kinds of different ways to try to lower your income tax, including making an RSP contribution. So that those are things that you're going to do. But then when you pass away, all those RSPs are going to be included in your final tax return. So if you're married, it rolls over to your spouse, and on the last death of a married couple, that amount of what's left in your RIF is going to go to taxation. So about 40%, even more than that, depending on how much money you have in your RRIF. So let's look at this together. Revenue Canada is reaching for your money when you pass away. So I'm going to lead you to a website where you can do this for yourself, and you're actually going to be able to go online and figure this out based on your own numbers. And I'm going to give you my numbers. Okay, so let's dig in this together. Okay, you're going to go to getsmartaboutmoney.ca. Getsmartaboutmoney.ca. This is an independent website run by the Ontario Securities Commissions. All of the financial institutions pay money to them to develop this website, so you will see no advertising on this site about any financial institution. So it is totally a place where you can go without any fear of having to worry about any advertisements. Everything about financial planning, retirement planning, different types of insurance products or investment products, strategies, and even calculators and tools. And so where you're navigating is to calculators and tools, and down at the bottom it says RRIF withdrawal. That's where we are in this particular. Let's click on it right now. That's where you are, and that's where I want to take you today. So as you scroll down here, you're going to put in your RRIF balance. So consider you've invested in RRSP, you're contributing all along, and you get to an age where you're going to start receiving an income from that. That's going to be you converting your RRSP to a RRIF. So let's look at that. Let's say you have $1 million portfolio. You put whatever value you have or what you think you're going to have at age, say, 65. That's the next box. Let's say somebody retires at 65. And the average mortality rate, that's a fancy word for when people die, in Canada is about 86. So I'm just going to put 86. You know what? I'm going to put 88 just so we can put a couple more years in there. And estimated annual RRIF growth. Most people that are investing money in their retirement aren't trying to hit home runs with their RRIF accounts. They're actually trying to conserve their money and grow it ahead of inflation. Even though inflation is going right now at more than 4%, I'm just going to leave it for 4% for now. If you put it at more than that, that just means your balance is going to be bigger. So let's just stick with that. Hit calculate. The next thing is just change this drop down menu to all rows. And you can see here you're 65 with $1 million, and you end the year with $999,000. That's because the minimum withdrawal for a 65-year-old with $1 million account is $40,000, but you made almost $40,000 in your growth. And you can see as you're going through the years, you made your withdrawal a little bit more, because that's how RRIF works. It's based off of your age, and each year that you get older, you have to take a little bit as a percentage, a little bit more each year. So you're going to see this number continue to go up. What do you notice here in year 3 of the retirement age here at 67? The withdrawal is greater. Actually, it's year 2. The withdrawal of $41,000 is greater than the actual growth. So you're actually now withdrawing more money than your portfolio is making. So you're going to see the balance begin to drop down, as you see here. So scroll down all the way to the end. And we're saying age 86. Let's just take age 88. This person passes away, and they have $535,000 in their RRIF. So what happens to somebody when they pass away with money in their RRIF? And this is the last death. If you're not married and you're a single person, then all of that money gets added to your terminal tax return, and that's how much money you earned that year. So what do you think the tax rate is on $535,000? It's more than 40%. But let's just say it's 40%. So my question for you really is very simple. What do you plan to do to lose $300,000 or more to Revenue Canada at the time of your passing? Now, some people legitimately have told me, I don't care, I've passed away, I don't care. But then there are other people that say, I spent my entire life trying to pay less money, at the lowest amount of money I can to Revenue Canada. I don't want to give it up when I pass away too. So what can I do about it? That's important. So that's the question I have for you. There's your 40%. It's a huge amount of money that goes to Revenue Canada if you're not going to do something about it. And just about everybody that I've ever come in contact with want to mitigate the amount of money that they're losing to Revenue Canada, so more money goes to your beneficiaries, to your charities, to your causes. This is really important. If you're maximum funding your RRSP, then you have money for life insurance. And now you're going to say, oh, he's going back to life insurance. But I got to tell you, life insurance is the magic here in estate planning. This is really what we're talking about, is estate planning. How do we lower the income tax to your estate? So look here, life insurance needs basically are final needs. So that's like funeral costs, right? Eliminating all debts. You have to pay off your debts when you pass away. taxes on your estate. The biggest taxes on your estate are going to be real estate that you own and any money in registered accounts that you'll have to pay tax, like a RRIF account. And then obviously you want to be able to do what's called planned giving money to your beneficiaries, children, charities, causes. These are things you want to do. And I don't think Revenue Canada is one of your charities, is it? So let's talk about what you can do about that. So many people see life insurance as an expense, when really life insurance multiplies your money. It takes $1 and turns it into $10. Now, of course, when you're older, it doesn't take $1 and turns it into 10. It might turn $1 into 5 or $1 into 6. But the idea here is it's multiplying your money. So if you can take some of your money today and have it multiply over the years so that at some point that life insurance has grown to, we're talking about participating in whole life insurance, has grown to the amount of money it's going to cover off all your final needs, paying your debts, paying your tax bill to Revenue Canada, and then to your charities and your causes and your beneficiaries, as much as you can afford. Then you want to take some money today and try to affect lowering the taxation in your estate. This is tax-free money from a life insurance policy. Your estate is paying for paying for all the taxes after tax dollars. It's a very painful and expensive way to pay Revenue Canada. Now, the way that you find out about how much money you're going to need to offset all the taxes that would go to Revenue Canada, largely due to your RRIF and to real estate, is get a financial plan done. I say it in every video. A financial plan is seeing the outcome of your planning decisions before you commit to them. It's such a powerful exercise to go through. It doesn't take up much of your time. Any financial advisor that's doing great work does financial plans for their clients. I do them all for my clients. They're included in what it costs. These are not extra costs to get them done. Although if you wanted one of these done, there are advisors that don't do manage money and all they do is do planning. You could go to them and spend $4,000 or $5,000 to get them done. They're included in what I do for clients. So this is the way in which you can solve this, is to start working with an advisor today to figure out how much money your estate's going to owe in taxes at any given year going forward. And then put insurance in place today that's going to grow over time to meet the demand or the need to pay off or pay down as much as you can afford the expense to your estate. I hope this was useful for you. I really enjoyed sharing this information with you. Remember, we take care of your wealth management so you can take care of what's most important to you. There's my contact information. If you have any questions, please feel welcome to reach out to me. I look forward to hearing your comments in the videos below. Go ahead and share and like this with anyone you think that really needs to see this information. And I look forward to seeing you in the next video. Thanks very much and take care.